Welcome back to The Wealth Effect. I'm your host, Green Moon, and today we're talking about real money. We earn it, we spend it, we save it, and we invest it. But what is the real value of money? The answer isn't as simple as checking your bank balance or counting the bills in your wallet. The real value of money is not just about how much you have, it's about what that money can buy. This concept is known as purchasing power, and it is one of the most vital yet misunderstood elements in personal finance and economic health. Today, we'll explore what purchasing power means, how it changes over time, why it matters more than the face value of your money, and how individuals and governments can protect it or destroy it. Let's fill your pocket. Let's start off with what is purchasing power. Refers to the quantity of goods and services money can buy. It answers the simple question, how far does your dollar go? You could be earning more dollars every year, but if prices are rising faster than your income, you're not getting richer, you're falling behind. For example, if $100 could buy you a cart full of groceries in 1995, but only get you a half cart in 2025, the purchasing power of that $100 has decreased. The value of money hasn't changed numerically. It still says $100 on that bill, but it just buys less. A quick perspective on its history. The US dollar, once tied to gold, has lost over 90% of its purchasing power since 1913, when the Federal Reserve was created. In 1913, $1 could buy you what would cost $30 today. The erosion of your purchasing power due to its natural enemy, inflation. Inflation is the silent enemy of purchasing power. It refers to the general increases in prices over time, and it is measured by indices like the Consumer Price Index or CPI. Inflation is the general rise in prices over time, and as prices increase, the real value of your money declines. It doesn't buy what it used to. Let's look at some examples. In 1970, the average new car cost around $3,500. In 2025, the same average new car could cost up to $48,000 or more. This is why purchasing power is inversely related to inflation. When inflation rises, purchasing power falls. When inflation is low, or during times of deflation, purchasing power rises. The dollar has become less powerful. Inflation compounds slowly but steadily. Even a 3% inflation rate cuts purchasing power in half in roughly 24 years. That means your dollar loses half its purchasing power in a single generation. This is why saving money in a checking account that earns near zero interest is in effect losing money in purchasing terms. And there are a few causes to inflation and currency devaluation. Understanding why purchasing power erodes, meaning understanding the causes of inflation, such as monetary policy, where central banks increase the money supply to stimulate the economy. But more money chasing the same goods means each unit buys less. There's also demand pull inflation. Strong consumer demands with limited supplies drive prices up. There's cost push inflation. When production becomes more expensive due to oil or wages, businesses raise prices. Currency devaluation happens when governments print excessive currency or devalue intentionally to boost exports, but purchasing power falls domestically. Inflation isn't always bad, but unchecked inflation is devastating. It has collapsed economies and destroyed generations of savings in countries like Zimbabwe and Venezuela. Nominal versus real value. This is where many people get financially misled. People often feel good about their salary increases or their portfolio growth in nominal terms. But if inflation outpaces those gains, you're no better off, and in fact, you might be worse off than before. We often look at our income in nominal terms, this being the raw number you see. But what we should be really looking at is the real value, adjusted for inflation. Here's an example. If you earned $50,000 last year and inflation was 2%, and this year you earned $52,000, but inflation jumps to 6%, If your income didn't increase by at least that much, you've effectively taken a pay cut without even realizing it. This means every year your dollar has to fight harder to maintain the same standard of living. In this example, your real income has gone down by 2%. You're earning more dollars, but your dollars became weaker. You, in theory, made more money, but your real income, adjusted for inflation, went down. And this is why understanding real and nominal value is critical when financial planning. And there's global differences when it comes to money. Purchasing power is also affected geographically. $1 in New York City might buy you a coffee lid. That same $1 in rural India or Southeast Asia could buy you an entire street meal. This is the idea behind purchasing power parity, or triple P, a metric economics used to compare the value of money across different countries by measuring how much a basket of goods costs in each. Triple P tells us more than just exchange rate. It tells us real economic life, what people can actually afford, not just what their currency is labeled as. Multinational corporations, investors, and economists use this metric to understand the real value of money globally, adjusted for the cost of living and economic strength. It also explains why digital nomads can earn US dollars and live like royalty in Thailand or Mexico. So why does this even matter in your life? Here's why. Your retirement savings are vulnerable to inflation. Your salary growth should outpace inflation to protect your lifestyle. Your investments need to beat inflation just to preserve purchasing power. Even your debt payments are affected by inflation. Purchasing power is what determines your standard of living, not just your income. And if ignored, you could think you're thriving, when in fact, you're slowly sinking. Here are a few ways to protect your purchasing power. Invest. Don't just save. Cash under the mattress loses value over time. Smart investing helps you grow your money at or above inflation levels. Choose inflation-resistant assets such as stocks, real estate, tips, which are treasury inflation-protected securities, commodities such as gold. These are traditional hedges against fiat currency devaluation. Increasing your earning power. Invest in yourself, new skills, side income, and career leverage to try to maintain your real income. Living below your means. Lowering consumption reduces your vulnerability to rising prices. And lastly, global mobility. Living or earning in different currencies or jurisdictions with higher purchasing power can help you save and invest for the future. The goal is not to hoard cash, but to turn it into assets that maintain or increase in real value over time. There are also more modern strategies, such as digital currencies as a store of value. In response to fiat currencies' decline, many have turned to Bitcoin and other currencies and other cryptocurrencies as alternative. The idea is simple. Limited supply preserves purchasing power. While speculative and volatile, digital assets represent a philosophical rebellion against inflation. Whether they succeed long-term remains to be unseen. But the shift in global desire for cryptocurrencies have allowed them to maintain their value. There is also the danger of lifestyle inflation, which is a silent destroyer of purchasing power. Spending more than you earn without actually improving the quality of your life. Even if your income increases, your real freedom doesn't. And over time, the gap between what people spend and what they truly need to grow becomes dangerous. True wealth is measured by how little you need to live well, not by how much you can spend. Purchasing power and retirement. Retirement planning must consider purchasing power over decades. It's not about saving $1 million if $1 million won't even cover basic expenses in 30 years. That's why successful retirees invest in inflation-beating assets, limit debt, maintain adaptable lifestyles, and factor in healthcare and housing cost inflation. Without this awareness, retirement becomes a period of financial vulnerability and not security. Purchasing power is the real metric of wealth. Money is a number, but purchasing power is a lifestyle. You can lose purchasing power without losing money. You can grow rich by protecting what your money can buy, even if the amount doesn't change. Inflation, market volatility, and policy shifts will continue to shape the economic world, but those who understand purchasing power and act accordingly will rise above it. The real value of money lies not in the amount, but in its utility, durability, and freedom it provides. The bottom line is, purchasing power is one of the most powerful and most overlooked concepts in personal finance. It's not just about how much you earn, it's about how much your money is worth in the real world. Your income may rise, your assets may grow, but if your purchasing power declines, your financial security is an illusion. So next time someone is talking about how much they make or how much they save, ask them a deeper question. What can that money really do? Because at the end of the day, wealth isn't measured in digits. It's measured in options, access, and freedom. And purchasing power is the gatekeeper of all three. Money is valuable in context. Purchasing power is about turning paper into possibilities. And that only happens when you understand what your money can do and should do for you. Thank you for listening. Until next time.